Hello again. In this video, we're going to talk about the types of financial institutions as well as the risks that financial institutions face. There are two types of financial institutions, depository and non-depository. For depository financial institutions, we have commercial banks. Commercial banks are banks that accept deposits and grant commercial loans. Therefore, the determining factor is whether the bank grants commercial or business loans. If the answer is yes, it is most certainly a commercial bank. Next, we have thrifts. These include savings and loans associations as well as savings banks. While savings banks are similar to commercial banks in that they accept deposits, they differ in that while commercial banks grant commercial loans, savings institutions focus on residential mortgage loans and other types of loans except commercial loans. And then we have credit unions. Credit unions differ from commercial banks and savings institutions in that they are non-profit and restrict their business to credit union members who share a common bond, such as, for example, a common employer. Therefore, credit unions accept the deposits from their members and grants loans to their members. This is also sometimes called a cooperative bank. For non-depository financial institutions, we have finance companies. Finance companies are financial institutions that grant loans to businesses and individuals. However, these companies are not allowed to accept deposits. This is how they differ from banks. Sounds familiar? Think lending companies. Then we have mutual funds. Mutual funds refer to financial institutions that pool financial resources and invest in a diversified portfolio. Mutual funds come with an experienced fund manager, so there is a good reason to believe that the fund is going to be managed with an expertise normally lacking or absent in an individual investor. Mutual funds are also highly regulated. This means that the fund manager can only invest in securities that are allowed by regulation, making them relatively safe. It works this way. Investors pool their money and buys into the mutual fund, which is managed by an experienced fund manager who invests in a variety of securities, thus the diversified portfolio, and passes back to the investors the returns less the costs to manage the fund. Now, before we proceed to the next, it may be interesting to discuss at this point what is known as hedge funds. A hedge fund is a financial partnership that uses pooled funds similar to that of mutual funds. However, they have a freer rein than mutual funds and are known for using higher risk investing strategies with the goal of achieving higher returns for the investors. The mantra of the hedge fund is the age-old maxim, the higher the risk, the greater the return. And then we have securities firms. Securities firms are financial institutions that underwrite securities and engage in securities brokerage and trading. As such, securities firm can either be investment banks or brokerages. Let's talk about investment banks. Do you know that an investment bank is not a bank? Nope, it is not. It does not accept deposits, so it cannot be a bank. An investment bank also does not grant loans. An investment bank is a financial institution that helps in the initial issuance of securities. Remember our previous example on IPOs? And how new issuances of shares of stocks go through an underwriter normally through an investment bank? An investment bank operates in the primary markets. Its primary purpose is to raise funds, or simply funding. Brokerages, on the other hand, help investors buy and sell or trade existing securities. As such, they exist in the secondary markets. The primary function of brokerages is to provide liquidity in the secondary markets by helping investors buy and sell securities. And then we have what we call insurance companies. Insurance companies provide individuals and firms with insurance policies that reduce the financial burden associated with death, illness, or damage to property. These companies charge premiums in exchange for the insurance that they provide. Lastly, we have pension funds. Pension funds are financial institutions that offer savings plans for retirement. The pension funds manage the money until the individuals withdraw the funds from their retirement accounts. The money that is contributed to individual retirement accounts is commonly invested by the pension funds in stocks or bonds issued by corporations or bonds issued by the government. Pension funds are highly regulated and are also viewed as generally safe. To recap, here is a diagram comparing the roles of the different financial institutions taken from Jeff Madura's book on financial markets and institutions. Now, let's talk about the different risks being encountered by financial institutions. There's just a few of them, about 10. It's sure what they say, with great power comes great responsibility. In finance, risk is the possibility of an unfavorable outcome. Heads up, we are going to talk about a lot of risks here, starting with interest rate risk. This refers to the risk that an asset will decline in value in response to interest rate movements. Suppose you have a 10-year bond that you acquired at a 3% interest rate. If the interest rate increases, you would have already lost the opportunity to earn more because your 10-year bond comes with a fixed income and a fixed interest rate. On the flip side, there is also what we call reinvestment risk, which is the risk that a financial institution will not be able to reinvest at a rate comparable to their current rate of return. Imagine if you invested money market securities in the past. Upon maturity, you wish to reinvest, only to find out that the interest rate has dropped. Sad, right? Next, we have what we call foreign exchange risk. This refers to the potential loss because the exchange rate of a particular currency moves unfavorably against a financial institution. Take, for example, if a financial institution invested in US dollars, predicting that the exchange rate will increase. If the foreign exchange rate decreases instead, then the financial institution has suffered a loss. Next, we have market risk, or sometimes called price risk. This risk is usually associated with a trading portfolio and is brought about by the volatility of the prices in, say for example, a stock market. If the price of the securities you have traded goes unfavorable, you've definitely been exposed to market risk. Then we have credit risk. This is the possibility of loss due to a borrower's inability to pay its loan. Since financial institutions shoulder the risk of default when it extends loans to its client, this risk is very common among them. This is the reason why creditworthiness must be established prior to granting loans. And then we have liquidity risk. This is the risk that the firm may run out of cash needed to pay its bills and keep the firm operating. And then we have what we call off-balance sheet or OBS risk. This is the risk that financial institutions face because of its contingent assets and contingent liabilities, as well as OBS financing. It is called off-balance sheet because these items do not appear in the face of the balance sheet. Rather, they are disclosed in the notes. And then we have technology risk. I know it's stating the obvious, but technology risk is the risk that technology will not work according to how it was designed, or technology failures disrupt a financial institution's operations, such as a system malfunction or information security breach. This is becoming more prevalent now as financial institutions migrate to online platforms. Then we have operational risk. It recognizes the risks that occur from conducting day-to-day operations. This might refer to the risk of losses as a result of inadequate management or controls, breakdown from internal procedures, employee problems, system problems, etc., etc., etc. Anything that's got something to do with conducting your day-to-day operations. And then you have country or sovereign risk. This is the risk that reflects how a government can affect the financial system of its country. This refers to how a country's political landscape, including but not limited to security and stability, as well as economic policies including tax regulations, affect financial institutions and its activities. And lastly, we have insolvency risk. In accounting, we all know that when liabilities are greater than assets, a business is insolvent. This is therefore the risk that the financial institution will not be able to satisfy its debts and have negative equity, or not having enough assets to pay off its liabilities. Considering the complex nature of financial systems and the important role that financial institutions play in it, it is but expected that they have to be regulated in order to protect the public. A country cannot afford to have a failure of financial institutions, as a failure in financial institutions would lead to a failure of financial markets and eventually to the entire financial system. And that's it. We have just completed our overview of financial markets and financial institutions. Good job, guys. See you in our next lesson.